Hey everybody, welcome back to 5 Minute Financial Markets. Well, the biggest week of the year is over, and despite the roller coaster that took place during the week, we only finished down 2.5% from Friday's close to today's close. But when you take it from the peak of the week on Tuesday, after that low CPI number, down to the bottom today, that's a 7% spread from the high to the low. What can we say about this week and this chart except it is looking ugly? Back-to-back days of gaps lower. We're actually starting to look a lot like this June sell-off back here, where we gapped 3 days in a row lower. But I've got to be honest with you guys, I'm really annoyed that I missed this. I should have seen this reversal coming after this big candle on Tuesday. It was so obvious this market had topped and was turning, and I just flat out missed it. Here's what I'm talking about. So first of all, we've got a very clear double top pattern that formed here. That's a typical bearish signal and a sign of a reversal. But more than that, this big green candle that came on Tuesday after the surprising pre-market CPI number was so clearly a blow-off top. And if you're familiar with Wyckoff method, this was an upthrust after a distribution. So here's what happened. We had a 2-month uptrend, lots of strength in the market. We hit this big resistance level that, again, I've showed you this before. This was the resistance line every single time we got to a top this year. We rejected off this line January, March, August, and here in December. So now we've rejected off that trend line and we're coming back up to retest it. Then that better than expected CPI number comes out Tuesday morning before the market opens and we gap up to 410. Now pre-market trading is much thinner volume than during the trading day. So the people who have a lot of money to throw around can really push prices around in the pre-market and the after hours market. And that's exactly what happened here. It was a textbook Wyckoff distribution, with this being the final upper thrust before it distributes lower. I know that hindsight is 20/20, but this one was so obvious I should have seen it at the time. This big green candle here was actually a big flashing red neon sign saying sell, 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 because the market is showing extreme weakness right now. And I just flat out didn't see it. But we are learning every day. The good news is I was long a lot of calls heading into that CPI number, so I was able to sell most of those at or near the top here within 15 minutes of the market open. I did hold on to a little bit of that length just in case we continued to melt up higher. That happens from time to time during bear markets. You get these big 4, 5, 6% up days, and I definitely wanted to be able to participate in that if this was going to be one of those days. But what I should have been doing is simultaneously buying puts so that if we got a big move to the downside, I'd be able to participate in that too. That's one of the benefits of being long options is you can buy puts and calls, and as long as you price the strikes correctly, it doesn't matter which way the market moves because a big move one way or the other will benefit you more to one direction than it will cost you in the other. In other words, in this case, I would have made more money on the puts than I would have lost on the calls. So either way, as long as there's big volatility, you win. Shout out to Dr. Cal at Money Time Machine, who not only saw this and called it, he actually predicted it the day before. I have a link to the video in the comments section. Check it out. It's very impressive. But the news is not all bad. If we go back to our divergence chart between smart money and dumb money, which we looked at yesterday, you can see that the divergence is growing wider. While the S&P hit a lower low today, the HYG still holds on to that higher low. Now, as long as this low stays higher than that, that's a positive sign for the markets. When you see divergences between the stock market and the bond market, the dumb money and the smart money, typically the bond market has it right. So if they're seeing strength, enough strength to hold up prices and not make a lower low, that is a positive sign that we may be reaching at least a local bottom soon. Doesn't mean it won't head lower, but at least in the near term, we might stop the bleeding. I also want to check in with silver again. As I mentioned yesterday, we could retest this channel that silver traded in for the previous few months. That's exactly what we did. We got right back into this shaded area and rejected off hard. This is a very, very bullish candle. It's called a hammer candle. And basically what happens is the asset opens, trades lower, finds a lot of support right here, and that pushes the price back up to close green and positive. And it makes sense that we would find support in this shaded area. Looking back over the last few years, every time we've gotten into this area, we've had big turnarounds when coming from the upside. Going all the way back to 2021, we've had multiple reversals when we've gotten into this shaded area. And it looks like, at least for now, that's held up again. I still see silver heading up to $25 an ounce in the very near future. That's all I've got for today. If you enjoyed this, please hit like and subscribe, and we'll see you next time.